Everyone's got an opinion on the size of this rate cut. Former New York Fed President, for instance, Bill Dudley, he now wants to see a 50 basis point cut. Meanwhile, Senator Elizabeth Warren is demanding that the Fed cut by 75 basis points. Let's bring in MonetaryMacro.com CIO Joseph Wong. And Joe, let me start with Senator Warren. Listen, she's always making, always pounding the Fed. We know this. But it does get to a fundamental question. Who does the Fed work for? Are they working for Wall Street or are they working for Main Street?
Well, first of all, thanks for having me. I think that's a really good question. Now, when I look at the Fed's actions, particularly how they interpret their mandate, I have to walk away with the sense that they're working for Wall Street. Why is that? Well, let's look at their inflation mandate, for example. Now, how are they interpreting that? Well, they can let equity prices go to the moon. They can let housing prices go to the moon. Basically, everything that the rich have can go to the moon. But what about everyone else? Main Street, who earns their living through wages. Now, the moment we see wage growth accelerate a little bit, let's say 3 or 4%, well, the Fed jumps into action and tries to do everything they can to stop that. And as a worker, I would imagine that has to look like maybe things are a bit rigged, not in your favor. Now, let's not forget that over the recent times, we've seen the Fed move heaven and earth to save the banking sector. Yeah. First in 2008, of course, jumping in, giving the banks huge bailouts, and of course, most recently, when we had that regional bank panic. So, I think the Fed means well, but it seems like the outcome of their actions has always been to the benefit of Wall Street rather than Main Street.
It was interesting. I was reading your note. You said 50 basis points would support a soft landing, but you also said a signal, that there's this lag effect also, maybe acknowledging that it does exist.
Yeah, so I think the 50 basis point cut seems like it. So we're really in a really interesting place where the market isn't sure whether the Fed will do 25 or 50. Now, sorry, Senator Warren, but the Fed is definitely not going to do 75. Now, the way that I look at this is that if the Fed does go and do aggressive rate cuts, on the surface, that'll look like it's helping the economy, that'll look like it's supporting the markets, but there's something else the market isn't focused on, and that is the impact these aggressive rate cuts will have on the U.S. dollar. Now, right now, the U.S. dollar is under a lot of depreciationary pressure because we have a very large fiscal deficit. If you look at the IMF's report, the U.S. stands out among all other developed countries having a projected fiscal deficit about 6% for the foreseeable future. For all other developed countries, it's about 2%. So that's a lot of downward pressure on the dollar. So far, that downward pressure has been kept at bay by high rates. Now, if the Fed goes and cuts 50 and cuts even more later on, there's going to be a lot of dollar depreciation. Now, that's going to trigger a couple of things. First, I think that's going to be upward pressure on inflation as commodity prices go up. But more importantly, over the past few years, a lot of foreigners have bought U.S. equities, U.S. Fixed income, and so forth. And foreign holdings of U.S. equities are basically at all-time highs. Now, when the dollar begins to depreciate, those foreigners are going to start losing money on the currency side, and they're probably going to sell. So that yen carry trade blow up we saw in early August, that could be just the beginning of something else if the dollar continues to depreciate. So I think these big rate cuts that we're shooting for.
Let me jump in there, Joe, because I got 30 seconds, right? These big investors, big traders are saying that the only game in town is the yen, right? This JPY trade, everyone's jumping on it. Is it in part because the Japan has to, at some point maybe hike rates, or is it because of what you just described, the inherent weakness in the U.S. dollar that might get worse?
Yeah, I think so. Both, it's the Fed forecasted to cut rates aggressively, but contrary to all other developed market central banks, the Bank of Japan is forecast to actually hike rates. So one country is cutting rates, the other country is raising rates, and so that argues strongly in favor of the Japanese yen, which is why we've seen the yen appreciate pretty significantly, actually by 10% in just 3 months. And so that looks like something that will probably continue if we do get the big Fed cuts that the market is expecting.
All righty, Joe. Hey, I always appreciate these conversations. Thank you very much. And